Tourmaline Oil Corp, TOU, occupies a commanding position within the North American energy landscape as Canada's preeminent natural gas producer. This report concludes that the investment thesis for TOU is fundamentally sound, anchored by its exceptional financial resilience, a strategically executed diversification plan into international markets, and a shareholder return model that is both generous and cyclical resistant. The core of the investment argument rests on three structural pillars: superior financial resilience, evidenced by a capital structure designed for sustainability through commodity troughs; strategic diversification, leveraging future liquefied natural gas (LNG) to arbitrage regional pricing risks; and compelling total shareholder return, driven by a dual payout dividend strategy. The core of the investment argument rests on three structural pillars: superior financial resilience, evidenced by a capital structure designed for sustainability through commodity troughs; strategic diversification, leveraging future liquefied natural gas (LNG) to arbitrage regional pricing risks; and compelling total shareholder return, driven by a dual payout dividend strategy. While the company's recent trailing 12 months (TTM) financial performance reflects the significant commodity price headwinds of 2024, the underlying operational metrics remain robust. The trailing profit margin as of the TTM ending September 2025 stood at a strong 30.26%, supported by an operating margin of 36.12%. Furthermore, management's disciplined capital allocation is highlighted by a minimal net debt to EBITDA ratio of 0.54 times, a level that provides an unmatched margin of safety among Canadian exploration and production E&P peers. However, the analysis must acknowledge the dichotomy presented by current valuation metrics. The company trades at a notable premium on TTM multiples, with its enterprise value to EBITDA (EV/EBITDA) ranging between 7.4 times and 7.9 times. This is substantially higher than the broader Canadian E&P sector median, which typically trades around 4.76 times to 5.14 times. This premium is not indicative of structural overvaluation, but rather the market's recognition of Tourmaline's superior operational efficiency, its high-quality reserve base, proved developed producing reserves of 1.35 billion BOE 6, and a 12-year reserve life indexed 7, and the high-conviction growth profile, which forecasts a 22% increase in average production over the next 5 years. A detailed examination of the price-to-free cash flow (P/FCF), currently observed at 60.23 times, further illustrates this cyclical distortion. This elevated P/FCF is the direct result of a temporary trough in free cash flow (FCF), which contracted to $1 billion in fiscal year 2024. For a capital-intensive business, FCF can exhibit extreme volatility during cyclical downturns, causing the P/FCF denominator to shrink rapidly. This highly cyclical figure should be disregarded in favor of forward-looking metrics, which indicate a substantial anticipated normalization of cash flow. Analysts forecast a meaningful compression in the EV/EBITDA multiple, projecting it to fall from 7.4 times currently to 5.4 times over a 2-year horizon and 5.2 times over a 3-year horizon, confirming market expectations for a significant FCF recovery driven by macro improvements and strategic execution. Analysis of the income statement performance. Revenue trajectory and commodity exposure. Tourmaline's income statement vividly demonstrates the inherent cyclicality of the upstream energy sector. The company experienced tremendous revenue expansion following the 2020 market recovery, with total revenue surging from $2.16 billion at the end of fiscal year 2020 to $4.288 billion in fiscal year 2021. This coincided with a sharp increase in the AECO benchmark price, which climbed 74% in 2021 and an additional 44% in 2022. However, the subsequent reversal in natural gas prices, particularly in the Western Canadian Sedimentary Basin (WCSB), has imposed severe pressure on the top and bottom lines. The AECO C price, the regional benchmark, decreased by 47% in 2024, averaging CDN $1.45 per gigajoule (GJ). This severe pricing environment led to a substantial contraction in reported profitability. Net income reached a cyclical peak of $4.487 billion in fiscal year 2022, only to fall precipitously. For fiscal year 2024, net income was reported at $1.264 billion, reflecting a sharp 27.18% year-over-year decline. The TTM net income to common shares, as of September 2025, totaled $1.325 billion, a 14.89% decline compared to the prior TTM period. The fluctuation in net income underscores why reported earnings, and therefore the price-to-earnings ratio, are often suboptimal for valuing E&P companies, which rely heavily on non-cash adjustments like depreciation and amortization, DA, and are primarily driven by highly volatile commodity prices. Cash flow metrics discussed in the next section provide a clearer view of underlying economic performance. Margin resilience and cost management. A distinguishing feature of Tourmaline is its ability to maintain high margins even during periods of commodity weakness, illustrating superior operational control and cost efficiency. Despite the volatile price environment up to September 2025, the company achieved a gross margin of 45.45% and an operating margin of 36.12%. The profit margin remained above 30%, settling at 30.26%. The sustained high operating margin, which strips out non-operating income and interest expense, demonstrates that the decline in net income is fundamentally an external problem rooted in commodity pricing, rather than an internal failing in operational execution or cost management. The resilience shown in these metrics confirms that the corporate cost structure is robust and likely best in class within the Canadian sector. Management continues to focus on protecting these margins proactively. Plans are in place to realize a 5% operational expenditure (OPEX) reduction in the Deep Basin during the next year, coupled with a further 5% reduction in drilling and completion (DNC) compared to current budgeted levels. These realized cost savings will serve as a crucial buffer against potential future weaknesses in natural gas prices, ensuring that any recovery in realized revenue will flow through efficiently to the cash flow statement. Cash flow generation and capital discipline. Free cash flow cyclicality and forward projections. The valuation of an E&P company is best understood through its ability to generate cash flow, particularly free cash flow. Tourmaline's cash flow history is marked by extreme cyclical swings, which is typical for the industry. Cash flow from operations, CF, was robust in Q3 2023 at $878.5 million, $2.55 per diluted share. However, FCF, defined as CF less capital expenditures, CapEx, fell sharply from its high watermark of $3.2 billion in 2022 to a forecasted $1.9 billion for 2023, and subsequently troughed at $1 billion for the full fiscal year 2024. This volatility led to FCF yield moving from a negative 1% in 2020 to a peak of 12.2% in 2023, before contracting to 3.8% in 2024. Forward guidance reflects a strong recovery, contingent on improving strip prices. Management forecasts full-year 2025 FCF to rebound to $1.4 billion, increasing from previous guidance due to better pricing expectations. Capital allocation and operational flexibility. Understanding the allocation of capital expenditure, CapEx, is critical for assessing FCF stability. CapEx is bifurcated into maintenance-sustaining CapEx, which is required to hold production flat, and growth CapEx, which is discretionary spending intended to increase production and operating cash flows. Tourmaline exhibits exceptional capital discipline and flexibility. While total capital spending, including $533.4 million in E&P spending during Q3 23, is necessary for the company's ambitious growth plan, a portion of this spending is non-essential in the short term. Management has stated that it retains the flexibility to defer approximately $200 million to $250 million of planned capital spending in a low-price environment. This discretionary spending buffer of up to $250 million defines the company's minimum necessary FCF threshold required for maintenance operations and provides structural protection for the base dividend. In the face of a severe downturn, the company can immediately curtail this growth CapEx, safeguarding liquidity and ensuring that cash flow remains available for core operational needs and shareholder return. This policy of deliberate capital flexibility minimizes the structural risk associated with FCF volatility. Commodity price sensitivity and AECO basis arbitrage. Tourmaline's FCF generation is highly sensitive to the differential between Canadian and North American benchmark natural gas prices, known as the AECO basis. The widening of the AECO C price differential versus Henry Hub to $1.29 per MMBTU in 2024 was a key factor suppressing 2024 FCF. Management provides clear guidance on this sensitivity, noting that for every US 0.10 per thousand cubic feet, MCF, that the AECO 5A basis tightens, the company's annual cash flow and free cash flow increase by approximately $50 million. This provides a direct path to FCF upside tied to macro and infrastructure improvements.
The macro outlook supports this thesis. The AECO basis differential is forecast to narrow significantly, anticipating an average of US 1.80 PMMBTU in 2025 and stabilizing near US $1 PMMBTU in 2026. If this tightening occurs as forecast or faster, the resulting structural improvement in realized prices will yield a massive injection into FCF. If the basis differential were to tighten, for example, by 0.80 MCF from current depressed levels, this would equate to an additional $400 million in annual FCF, rapidly accelerating cash flow normalization and justifying the market's positive forward-looking stance. This strong correlation between FCF and AECO basis tightening confirms that Tourmaline's earnings power is structurally leveraged to the eventual commissioning and utilization of Canadian LNG export infrastructure. Balance sheet strength and solvency analysis. Pristine leverage profile. Tourmaline's balance sheet is characterized by exceptional financial strength and ultra-low leverage, which serves as a critical differentiating factor and a primary justification for its premium valuation. The company operates with a minimal reliance on debt relative to its operational capabilities. As of the TTM ending November 2025, the debt-to-EBITDA ratio was remarkably low at 0.54 times. This is substantially below the internal target leverage and industry norms, which often tolerate multiples well over 2.0 times. Furthermore, the debt-to-equity ratio stands at only 0.11, reflecting a substantial reliance on internal equity for funding its assets. Total shareholder equity as of September 2025 was approximately $16.375 billion. The company has successfully managed its net debt, exiting Q3 2023 with net debt of $879.8 million. This figure was well below the company's long-term net debt target range of $1.2 billion to $1.4 billion, indicating a consistent policy of deleveraging and maintaining high financial flexibility. This extremely conservative capital structure ensures the company remains resilient against interest rate fluctuations and cyclical revenue declines. Total assets as of September 2025 reached $23.74 billion, while total liabilities were $7.368 billion. Debt service and coverage metrics. Solvency metrics confirm that the outstanding debt carries minimal risk. The company's interest coverage is exceptionally high, measured at 21.88 times, with alternative calculations showing 26.3 times coverage by EBIT. This robust coverage indicates that operational profits are more than sufficient to meet interest obligations many times over. For Q3 2024, interest expense on debt was a manageable $18.1 million. Additionally, operating cash flow provides coverage of 193% of the total debt. This superior debt coverage ratio highlights that FCF is not constrained by mandatory debt service, but can be immediately directed toward growth capital or shareholder returns. The ability to successfully operate with a debt-to-EBITDA of 0.54 times creates significant strategic optionality, allowing management to deploy capital toward counter-cyclical acquisitions or fund the extensive NEBC growth infrastructure project without requiring external dilutive financing. Liquidity ratios. The analysis of current liquidity ratios reveals metrics that are characteristic of the E&P sector. The current ratio is 0.48 and the quick ratio is 0.32. These figures are low in absolute terms, but they do not signal impending distress. E&P firms typically minimize cash held on the balance sheet, $70.02 million cash and equivalents, and instead utilize high cash flow from operations, CFO, to manage immediate liabilities. Given the overwhelming debt coverage and rapid cash generation capability, the low current and quick ratios merely reflect efficient rather than distressed working capital management. Dividend safety and shareholder return framework. The dual dividend policy. Tourmaline employs a sophisticated dual payout strategy designed to optimize capital allocation throughout the volatile commodity cycle. This framework consists of a stable, growing quarterly base dividend and flexible, intermittent special dividends. The purpose of the base dividend is to provide shareholders with a predictable, sustainable income stream that can withstand low commodity price environments. The quarterly base dividend was recently increased by 7% in Q2 2024 to $0.32 per share, $1.28 per share annualized. This policy is subject to review, but aims to be protected even during cyclical downturns. In contrast, the special dividend acts as a mechanism to return excess free cash flow generated above the requirements for maintenance capex, the base dividend, and debt targets. Since hitting its net debt targets in 2021, Tourmaline has returned an impressive cumulative total of $13.25 per share in special dividends. Recent special dividends include a $1 per share special dividend paid in Q3 2023 and subsequent smaller but frequent special payouts. Example, 3 payments of $0.35 per share were declared across 2025. Robust dividend coverage. The safety of the base dividend is exceptionally high. Given the forecast FCF of $1.4 billion for 2025 and even the conservative 2026 forecast of $0.9 billion, the annual cost of the base dividend is well covered. The stability of this payout is structurally supported by the company's capital discipline. The ability to defer $200 million to $250 million of growth capex, as discussed in Section 3, serves as the primary line of defense. Should commodity prices weaken substantially, management can instantly redirect this planned growth spending, converting discretionary capex into FCF to ensure uninterrupted payment of the base dividend and funding of essential maintenance. This dividend structure functions as a form of capital disciplinarian. By committing to returning excess cash flow via special dividends, management is implicitly prevented from engaging in value-destructive growth projects that do not generate adequate cash flow. Any significant increase in capital spending must be justified by strong FCF generation, or the spending will be curtailed, thereby linking the company's capital structure directly to market responsiveness. Total shareholder yield. While the base dividend yield is modest, the total shareholder yield, inclusive of special dividends, provides a highly compelling return profile. The total yield, factoring in the intermittent but recurring special payouts, is estimated to be closer to 9%. This model appeals to sophisticated investors by offering security through the base payout and substantial upside exposure to commodity price surges through the special dividend distribution. Current valuation. Traditional multiples and cyclical distortion. An examination of Tourmaline's current valuation reveals significant distortion caused by the commodity trough of 2024, reinforcing the need to employ specialized metrics for the E&P sector. The trailing price-to-earnings ratio is high at 17.92 times, though the forward PE ratio improves to 13.61 times. More strikingly, the trailing price-to-free cash flow multiple stands at an inflated 60.23 times. This extraordinary number is purely an artifact of depressed FCF, $1 billion in 2024, used in the denominator, illustrating the inherent unreliability of cash flow multiples when cash generation is at a cyclical low. Enterprise value to EBITDA analysis. The enterprise value to EBITDA, EV to EBITDA, is the preferred valuation tool for energy producers, as enterprise value incorporates debt and equity, and EBITDA, earnings before interest, taxes, depreciation, and amortization, strips out non-cash charges and capital structure differences. Tourmaline's TTM EV to EBITDA multiple is high, ranging from 7.4 times to 7.9 times. This contrasts sharply with the Canadian E&P industry median, which typically trades below 5.2 times. For example, Canadian Natural Resources (CNQ) trades closer to 6.1 times. This substantial premium suggests that the market has already factored in several years of anticipated growth and de-risking initiatives. Justification of the valuation premium via forward multiples. The market is currently pricing in a significant normalization and growth trajectory in future cash flows, leading to an anticipated multiple compression. Forward EV/EBITDA projections show a sharp decline, 6.6 times 1 year forward, 5.4 times 2 years forward, and 5.2 times 3 years forward.
This strong anticipation of cash flow recovery is structurally supported by three factors, which collectively justify the current premium. Balance sheet strength. The exceptional leverage profile, 0.54x debt/EBITDA, fundamentally reduces the equity risk, which warrants a higher valuation multiple relative to more leveraged peers. Growth trajectory. The confirmed long-term growth profile, aiming for 22% production increase over 5 years, provides earnings visibility absent in many competitors. De-risking strategy. The strategic pivot toward LNG export markets, as detailed in Section 7, secures a higher, more stable future realized price, significantly enhancing the quality and predictability of future FCF, which reduces the required risk premium applied by investors. The high P/FCF and TTM EV/EBITDA figures are therefore misleading indicators of current value. The forward-looking multiples demonstrate that the stock is being priced based on its expected, structurally superior cash flow generation in the 2027-2028 timeframe. Strategic growth drivers and risk assessment. Macro environment and price forecasts. The operational success of Tourmaline is intrinsically linked to the trajectory of North American natural gas prices. The recent trough in AECO prices, CDN 1.45/GJ in 2024-11, created the cyclical financial drag observed in 2024 results. However, the forecast indicates recovery, with AECO-C expected to rise to CDN 2.71 GJ in 2025 and reach CDN 4.37 GJ by 2034, driven by increasing long-term demand and infrastructure adjustments. For liquids exposure, the outlook for crude oil, WTI/Brent, remains constrained. Prices are anticipated to remain congested, likely trading within the $52 to $75 per barrel range into 2026, due to abundant supply and long-term pressures from the energy transition. Given Tourmaline's primary focus on natural gas, this stable, albeit capped, oil price environment supports supplementary liquids revenue without introducing excessive risk. Structural de-risking through LNG export. The most significant long-term growth driver and de-risking catalyst for Tourmaline is its commitment to shifting gas sales away from the regionally constrained AECO hub toward international markets via LNG export. This strategy leverages the company's status as Canada's largest natural gas producer. Tourmaline is actively building its exposure to international pricing benchmarks like the Dutch Tidal Transfer Facility, TTF, and the Japan-Korea Marker, JKM. The company has secured important long-term contracts, including an 8-year physical gas supply agreement with the German energy firm Uniper, commencing in November 2028 for 80,000 MMBTU per day. This contract provides crucial international price exposure and aligns Tourmaline with the European imperative for enhanced energy security. Total international pricing exposure is set to increase substantially, from an average of 213,000 MMBTU per day in 2026, growing to 253,000 MMBTU per day by the end of 2027, and reaching 333,000 MMBTU by the end of 2028. This structural pivot mitigates the volatility associated with regional basis risk, securing higher, more stable netbacks, and is a key factor supporting the forward multiple contraction anticipated by analysts. Reserves and production growth strategy. The foundation of Tourmaline's long-term export capability is its robust reserve base. The company holds 5.5 billion barrels of oil equivalent, BOE. The proved reserve life index is a very conservative 12 years, providing the longevity necessary to underwrite the multi-year LNG supply commitments, like the 8-year Uniper deal. This substantial asset base is being expanded through the strategic development of the NEBC, Northeast British Columbia, infrastructure project, described as the largest E&P growth project in the WCSB over the next 5 years. This build-out is designed to add 1.1 billion cubic feet per day of new gas and over 50,000 barrels per day of condensate and natural gas liquids, NGLs, over the next 6 years, securing the forecasted 22% production growth.
The unique combination of a massive long-life asset base, 2P reserves, and a minimal debt/EBITDA ratio, 0.4 times, positions Tourmaline as a highly creditworthy, structurally de-risked supplier for large international counterparties. This dual strength allows the company to secure premium long-term contracts that are out of reach for less financially robust peers. Key investment risks. Despite its structural strengths, Tourmaline faces execution and macro risks. The foremost risk remains commodity price volatility, particularly if the AECO basis differential fails to narrow as quickly or as much as forecast, undercutting projected FCF. The NEBC expansion also carries inherent execution risk, where potential construction delays or cost overruns could impact the timing and cost of production growth. Furthermore, investor sentiment can shift rapidly. The downgrade by Zacks Research to a strong sell in October 2025, based on weakening crude oil prices and immediate earnings misses, Q3 2025 EPS miss, highlights ongoing market sensitivity to near-term results. While the rationale behind the downgrade emphasizes weak short-term momentum and perceived current overvaluation for value-focused investors, the forward-looking strategic value remains high. Final conclusion. Synthesis of financial performance. The comprehensive analysis confirms that Tourmaline Oil Corp is an exceptionally high-quality enterprise in a cyclically volatile industry. The income statement demonstrates excellent internal operational control, maintaining strong operational margins, 36.12%, despite substantial commodity price headwinds. The sharp contraction in reported net income must be viewed as a temporary external phenomenon. The cash flow statement reveals a highly flexible capital structure, underscored by the ability to defer up to $250 million in growth capital. This flexibility guarantees the stability of the base dividend and positions the company to realize massive FCF upside as the AECO basis tightens. The balance sheet is unparalleled in the Canadian E&P sector, evidenced by a 0.54 times debt/EBITDA ratio. This level of financial conservatism provides optionality for future growth and M&A activities while insulating the equity from debt-related risk. Conclusion on valuation. The current high trailing valuation multiples, e.g. 7.4 to 7.9 times TTM EV/EBITDA, are justifiable and sustainable based on its company's structural advantages and credible growth forecast. The current high P/FCF ratio, 60.23x, is a misleading artifact of a cyclical trough, a phenomenon that is neutralized by analyzing forward metrics. The rapid anticipated compression of the forward EV/EBITDA multiple, projected to fall to 5.4 times in 2 years, strongly indicates that the current share price reflects the market's high confidence in the success of the LNG diversification strategy and the realization of associated structural cash flow improvements. This forward-looking valuation suggests that the stock is currently undervalued relative to its expected future earnings power. Tourmaline Oil Corp is recommended as a core holding for institutional portfolios seeking high-quality exposure to the Canadian natural gas market. The investment proposition combines the safety of an ultra-conservative balance sheet with compelling structural growth driven by the successful strategic pivot to lucrative international LNG markets. The base dividend is secured by operational cash flow and protected by discretionary capital buffers, providing a stable income foundation. The potential for substantial special dividends remains a powerful incentive tied directly to the realization of higher future FCF resulting from reduced AECO basis risk and increased production volumes. The company is strategically positioned to outperform its peers as North American gas exports transition into a global market play.